Greetings, everyone, and welcome to the Prince George's Community Federal Credit Union 2022 Student Advantage Webinar Series. Today's presentation is brought to you in partnership with Coffee, a nationwide financial coaching and education center focusing on improving the financial health of individuals. As the premier credit union of Prince George's County, we have joined with Coffee to expand our mission of providing quality financial education to our community and lending insight into credit management, home ownership, and money management. Prince George's Community Federal Credit Union is a full-service financial institution serving anyone who lives, works, or worships in Prince George's County, Maryland. We are one of the county's best-kept secrets with competitive loan and savings rates, as well as discounts to national retailers. We currently serve over 17,000 members in the area and welcome you to come and experience the benefits of membership as well. Later in this presentation, we will also display our contact information so that you may contact us with any specific questions you may have concerning your financial needs. In celebration of April being National Financial Literacy Month, we are proud to be able to present these webinars and other products to help guide young adults throughout their financial journey. Lastly, today's presentation is available for viewing at www.princegeorgescfcu.org/student advantage. And with that, we will turn it over to Ms. Doris Baker.
Thank you so much, Gerald, and thank you everyone for joining us on the webinar titled Understanding Credit as a Tool. Now, credit is a term that you will hear from now on throughout life. And as you can see on the screen before you, credit is your ability to borrow money. Anytime a bank, finance company, or business lends you money and you agree to pay it back at a later date, guess what? You are using credit. In most cases, there is a charge for borrowing the money, either in the form of fees or interest, or even both. Next screen, please. There are 5 C's that lenders consider when we talk about credit. They are character, capacity, capital, collateral, and conditions. Let's talk a little bit more about each of those in depth. First, character. When lenders evaluate character, they look at stability. For example, how long you've lived at your current address, how long you've been in your current job, and whether you have a good record of paying your bills on time and in full. If you want a loan for your business, the lender may consider your experience and track record in your business and industry to evaluate how trustworthy you are to repay. The next C is capacity. Lenders need to determine whether you can comfortably manage your payments. Your past income and employment history are good indicators of your ability to repay outstanding debt. Income amount, stability, and type of income may all be considered. The ratio of your current and any new debt as compared to your before tax income, known as debt to income ratio, or DTI for short, may also be evaluated. Next is capital. While your household income is expected to be the primary source of repayment, capital represents the savings, investments, and other assets that can help repay the loan. This can be helpful if you lose your job or experience other financial setbacks. Collateral. This is used when applying for secured loans. Loans, lines of credit, or credit cards you apply for may be secured or unsecured. With a secure product, such as an auto or home equity loan, You pledge something you own as collateral. The value of your collateral will be evaluated, and any existing debt secured by that collateral will be subtracted from the value. The remaining equity will play a factor in the lending decision. And lastly, is conditions. Lenders may want to know how you plan to use the money and will consider the loan's purpose, such as whether the loan will be used to purchase a vehicle or other property. Other factors, such as environmental and economic conditions, may also be considered. And with conditions, it's good to note that it could not only be you as an individual or you as a business, but it could also be the condition of the economy in your area in which you would like to borrow, meaning your state or maybe nationally at large. Okay, next slide, please. Credit score. Now, here we have a definition of credit score. It's simply a snapshot of a person's credit picture. Your score is assigned based on borrower's level of credit risk. Higher the score, requests for credit will be approved and most likely receive favorable interest rates. Credit scores changes for good or bad over time, depending on your credit history. Next slide. Here you see a graph of credit scores, and we'll just start with the good first. You see excellent credit is 720 to 850. Good credit is considered a score between 690 and 719. Fair is anywhere between 630 and 689. And poor or bad credit is considered anywhere between 300 and 629. The average score here in the United States is 716. That is the average credit score. Let's move on to the next screen and talk about what makes your credit score. As you can see from the chart before you, 35% of your credit score is your payment history. That's whether you pay on time or not. Okay, 30% is amount owed. Remember, a slide or two back, we talked about the debt to income. Well, that 30% is based on how close do you come to your credit limit when it comes to revolving credit. Just a point that it's good to stay 30% or less of your assigned credit limit. 10% is new credit, okay? 15% is length of credit history. So if you have a credit card, you're issued a credit card and it's in good standing, never close out that credit card because it shows your credit history. And 10% is types of credit. Lenders like to see that you can manage a, let's say, portfolio of credit, that you would have an installment type loan, a personal loan or a auto loan, and that you would be able to handle credit cards and pay them on time. They do not just want to see you with a wallet full of credit cards because eventually it will seem as though you're living off credit. Next slide, please, Gerald. Now, this chart just simply shows how credit problems can impact your credit score. You can see that this individual we're using in this scenario has a credit score of 780, but the score drastically drops after just one of the things listed below happens. So you will go from 780 to approximately between 735 to 755 just by maxing out a credit card. Okay? From 780, you can go from 670 to 690 just by being 30 days late on your mortgage. So you can see that the worst case scenario, of course, is a bankruptcy. Now, this isn't written in stone. This is just used as an example, but this is by just taking data and compiling it, and this is the average of what can happen should you be adversely impacted by any of these credit problems shown on your screen. Let's look at some examples of credit score by going to our next slide. Okay, so we're going to Brown's Luxury Cars. And say, for instance, in this scenario, you're going to purchase a car. You have a down payment that you're willing to use of $1,000. Your annual income is $27,000. You've been on your job for 1 year. However, your credit score is 542. Okay, 542. For you to get, say, even an $18,000 car with that credit score, you will be paying an interest rate of anywhere from 16 to 30%. Your purchase price, of course, is $18,000. You have that $1,000 to put down. You don't have a trade-in. You most likely will not qualify for any type of rebates. Your credits, your interest rate will be 27%. The number of months on your loan would be 72 months, and your payment would be $479.01, and the total interest paid over those 72 months would be $17,488.99. So you see that with that lower end credit score, you're paying a lot of money in interest. Let's just use one more scenario. Say your down payment will be $3,500 because you're not over your head in debt. You've been able to save maybe bonuses and different types of things. Your annual income is still at $27,000. You've been on your job for 4 years and your credit score is 678. Same purchase price of $18,000 with a $3,500 down payment. Your interest rate, because of that credit score, okay, and that you're financing less, is 6.5% for those same 72 months. Your payment will now be $243.74, and the total interest paid over the life of the loan will be $3,049.57. Wow, that is incredible. The difference in the monthly payment itself is $244.27. So you can just see by example. Now that was with a bigger down payment. Let's use a similar scenario. Still $18,000 purchase price, that $1,000 down payment that we initially used. With that higher credit score, you'll have an interest rate of 6.5% there again. 72 months is the length of your loan. Your monthly payment will be $285.77 in this scenario. And the total interest paid over the life of the loan will be $3,575.35. So you see the savings even without having the larger down payment, because you're afforded a more favorable interest rate at that 6.5% versus our first scenario with that lower credit score. You had a 27.5 or somewhere in that area, interest rate. So it is important to maintain good credit. Now, that's the price you would pay at Brown's luxury cars. Of course, there's the chance that you would not even be able to purchase from Brown's luxury cars. And you can see from our next slide, you may have to go to an alternative car lot. Here, we call it Hoopty Heaven. And at Hoopty Heaven, you buy here, you pay here, but you see your choice of vehicle. Also keep in mind that as we see on the next slide, that credit scores are also pulled. Your credit report is pulled when you go to apply for a job, be it part-time, be it full-time. It used to be where it was just working in the finance area. That is not true anymore because employers feel that if you're good with your finances, that you're an integral person. There's a certain level of integrity that you may possess. So you may go to college, be in college, get that degree, graduate in a good status in your class, and you're looking to be employed at this prestigious company or business, but your credit fails and then it becomes questionable. The next candidate that comes in with good credit may be the next new employee at Williams Parks and Associates CPA. You, on the other hand, could end up at a place like our next slide depicts. Next slide, please. And who in the world wants to work at super sloppy sandwiches with no benefits and need I say anything else? Of course, if you're not even ready to purchase a home, say that you are going to rent a place, that your credit is also pulled by most rental agencies. Oh, yes, it is. So there you could go and apply. Next slide, please. At Heavens Estates, you see the nice pool, the amenities. They probably have tennis courts and golf courses, everything that a young person would enjoy, a weight room and all these different amenities. But because of your credit score, you could be declined and the property could be rented to the next applicant, whereas you may have to start looking at a place, as our next slide will show, slumtown apartments. Okay, so credit is very, very important. We made that a little entertaining and a little far-fetched, but in reality, it could make the difference between you getting the job, getting the car of your dreams, and living in the neighborhood of your dreams. We have some quick questions for you. So next slide, please. Now, here's a question. A lender will give you the best interest rates if your credit score is A, 500 or below, B, 650, or C, 780 or higher. Of course, our answer is 780 or higher. The higher that score, the more favorable your loan conditions presented to you will be. Next slide for our next question. Payment history, as we saw from a previous slide, is 35% of the credit score. That means all by itself, your payment history makes up 35% of your credit score. Which of the following apply? So you had foreclosure 9 years ago. You tithed to your church for many years. You always pay your bills on time and declared bankruptcy 6 years ago. Now, there could be a close race between C and D, but we're going to choose C, that you always pay your bills on time, okay? That is going to really affect your credit score, even though all these other things that are showing A, B, and D are things that may have happened in your credit life, but because they're almost at the end of the road, as far as the foreclosure is concerned, as far as the declaration of bankruptcy, and whether you pay tithe at your church or not really doesn't affect your credit, but paying your bills on time does. So we're going to say C. Let's look at our next slide for your responsibilities as a credit user. Borrow only what you can repay. And it does not mean where you can fit the minimum monthly payment into your budget. Borrow only what you can repay simply means that you can repay whatever it is you use on your credit card. Yes, the ideal usage of credit is to use it and pay it off immediately. You don't get any brownie points for carrying a balance. All you get is interest accrued, and if you pay late, a late fee. Read and understand your credit card contract. The small print that comes along with your credit card, read it. Pay debts promptly. Always notify your creditor if you cannot make your payments. Avoid buying on impulse. Don't be an emotional spender. Report lost or stolen credit cards promptly. Never give your card number over the phone unless you initiate the call or you're certain of the identity of the caller. So just because they may identify that they're from your credit card company, no ma'am, no sir, you hang up and you give a call back to the number that's presented on the back of your credit card. Next slide, please. Here again, tips for using credit wisely. Follow your agreement. Pay your credit cards according to the terms of your agreement. You may want to consider paying your credit cards online or over the telephone to avoid being late with your payments and thereby incurring late fees. Keep balances low. Do not charge anything more on the card until you've paid off your account balance, okay? Keep your balances at approximately 10% or less of your available credit. Remember, I said earlier, 30% is the ideal, but 10% just shows that you can really steward yourself when it comes to credit card usage. And last but not least, read all important information. Always, may I say always, read your statements and all information sent by your creditor, as it may be very important changes to your particular account. As we go to the next slide, we're continuing with tips for using credit wisely. Listen, don't skip payments. You will be charged late fees and penalties. And guess what? We've already talked about it. It will damage your credit as well. Don't go over your credit limit. Now, exceeding that limit or getting close to it will damage your credit history and lower your credit score. And on top of incurring fees if you go over. So the closer you get to that credit limit, the more detrimental it can be to your credit score. So you want to keep a good eye out for that. Minimize your use of cash advances. This is usually a very expensive source of funds. I would like to say when it comes to cash advances, pretend that you don't have an option for a cash advance. That is when you get cash from your credit card. We're going to pretend that we don't even have that. Don't buy credit card protection plans, and this is the reason why. This tends to be highly priced, and mainly serves to generate big profits for card issuers, meaning that when it comes to time for you to use your credit card protection, the small print usually enables you from doing so because you have to jump through hoops and leap over walls. It's very hard to get that benefit, and we find that it's not even worth purchasing. Let's move on to our next screen. What is on your credit report? Just when we've talked a bit about credit scores and credit cards, let's talk about that credit report. The first step in building a better credit report is to understand what's on your credit report. There are three major credit reporting agencies, and you can get a free credit report simply by contacting www.annualcreditreport.com, or you can call the number. The credit report has some information zones there. Basic information, your personal information, your lines of credit, anyone that has done inquiries on you. You want to pull your credit report at least once annually from annualcreditreport.com. Let me let you know that you're able to get one credit report within a 12-month period via annualcreditreport.com from each of these credit reporting bureaus you see here on your screen. You could get one from TransUnion, say in the early part of the year. You can get another one from Experian, say in the middle part of the year. And at the end of the year, you could get that final report from Equifax. I will repeat that same process every year so that you can ensure that your credit report, everything is being reported correctly. You want to be proactive the older you get and you're issued credit to make sure that you are keeping up with what's going on your credit report. Lastly, from what I have here, if we can go to the next screen. And this is just an example we have of a gentleman who has an almost perfect credit score. You see Mr. Pavelka there has a credit score of 848. He received a letter from Experian informing him that his credit score was higher than 100% of US consumers. And these are just some tips that he offered, okay? He pays his bills on time. We figured as much. He never spends money without having a plan to repay it, okay? He has a strategy. He does have a mortgage. He has an equity line. He has 4 credit cards he actively uses, then pays off at the end of the month. That's the ideal way to use credit. He has 4 other credit cards with available credit. I guess these would be just his emergency cards exceeding $100,000, okay? So he has cards that he does not even use. Just because he's issued a card or just because we're issued a card does not mean that we have to use them and carry balances on 8 different credit cards, if we even need that many. But he's worked his way up to honorable mention, okay? That is the end of my presentation that I have for you. I'm going to turn it over now to Gerald. Gerald, thank you. It's all yours.
All right. Thank you for attending today's educational webinar. If you'd like to learn more about Prince George's Community Federal Credit Union, or you'd like to speak to a member service representative, please visit us at www.princegeorgescfcu.org, or you can call us at 800-952-7428. We would like to thank our presenter, Ms. Doris Baker, again, and Coffee for their continued support. If you like to schedule a free financial consultation, you can call Coffee at 866-459-5165. Thank you and have a great day.